All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. So if you've been searching the internet looking for information on investing in real estate using a life insurance policy, you've come to the right place. So be sure to bookmark this site right now and subscribe so that you're notified whenever I come out with any new videos. So today we're going to be talking about why you shouldn't rely on the illustrated crediting rates or dividend rates when you're evaluating a life insurance illustration or a policy, and what you should be looking at instead. So let's just face it. Do you really think that interest rates are going to stay where they are right now for the next 30, 40, or 50 years? That's highly unlikely. Yet, when we run life insurance illustrations, we typically use one rate and we project that forward for the life of the insured. And that is completely unrealistic. So those policy illustrations are out of date literally from the moment that the policy is issued. So what I want to do in this video is show you what you should be looking at instead and why the life insurance illustrated rate is not a valid measure. So if that sounds interesting to you, stick around after the intro and we'll get started. All right, thanks for sticking around. I'm Tom Rutkowski with Innovative Retirement Strategies, and I created the Double Play channel because I know how hard it can be to try and find information on the internet. A lot of sites have pretty pictures, but they don't have a lot of detailed information. And I want this channel to be a good source of information for you to answer all of your questions. And I provide this information for free because I'm pretty confident that you want to deal with somebody who understands what they're talking about. So the goal of this channel is to give you everything that you need to know without ever talking to a life insurance agent, so that you can invest in real estate using your life insurance policy and build wealth utilizing the Double Play. So if I've done my job right, all of the questions that you have should be answered in these videos. If you still do have questions, be sure to post them in the comments down below where everybody can see them and everybody can benefit from the answers. And I do respond back to the questions very quickly. So the goal of today's video is to show you why you should not compare illustrations based on the illustrated crediting rates used by the insurance company. And I'm just going to take a little bit of time and explain what the illustrated crediting rates are, why they shouldn't be relied upon, and then show you what you should be looking at instead. So before we get started, let me take care of a little bit of housekeeping. I just want you to be aware that all of this information is purely educational. There's no tax advice, no legal advice, no financial advice. And the primary purpose of life insurance is for the death benefit protection. Any other benefit is purely ancillary. All right, so let's get started. What are the illustrated crediting rates? When I say that, what am I talking about? The illustrated crediting rates are the rates that the life insurance company uses to project the cash values and death benefit of the policy over the life of the insured. And to be quite blunt, they're just a guess, just a number that they're pulling out of thin air. In the case of a whole life company, those rates are typically based on the current dividend rate that the life insurance company is paying. And I mean, if you've looked at any historical graph, you know that interest rates since about 1982 have been falling. Prior to that point, they were rising. So just about any life insurance illustration that was made in the last 40 years was made at a rate that was higher than what the policy actually earned. So the rates, the illustrations are basically out of date from the time that the policy is issued. Conversely, if we're in a rising interest rate climate, then we're relying upon an illustration that's based on rates that are low, and future rates might be higher, in which case your policy will actually perform better than it was illustrated. So that's how the projected rates are on a whole life. On an index universal life, The rates are typically based on, or are based on, the actuarial guidelines 49 and 49 alpha, so also known as AG 49 and AG 49A. And these are guidelines that the insurance industry came up with to keep companies and agents from showing illustrations that were using too high of a rate on indexed universal life. And the guidelines are very reasonable. So really what's happening, and I'm glossing over it quite a bit, but they're applying today's current cap rate back over the last 25 years of historical market data to determine what an IUL would have performed had it been in place, had the caps been at this rate today for the last 25 years. So there's actually much more to it than that. They go back cast much further than that. But the second part of it is they cannot show a projected rate for the values that's more than 145% of what their current general fund is actually earning at the present time. So there's some limits on how high of a rate that they can show. Now, it's important to understand that in an indexed universal life, it's the earnings on the general fund that give the life insurance company the budget with which to do their hedging. And if you don't understand how an indexed universal life works and what I'm talking about when I say hedging, I've got a ton of videos that I'll link above and in the description that explain how an indexed universal life works and how they are able to capture a higher crediting rate than a whole life. So again, when interest rates are low as they are today, future actual interest crediting rates are likely to be much higher if we go into a rising interest rate climate, and just the opposite if we're going into if rates continue to be low or go even lower. But whatever the case, an IUL still allows the insurance company to capture a premium over what they're earning on their general fund, and that's where the 145% comes into play. All right, so now that you understand what the interest crediting rates are on a life insurance policy, why shouldn't you use them? Well, a picture is worth 1,000 words. So let's take a look at this graph for a few minutes. And this is a graph of interest rates over the last 100 years, going back to 1920. And if we look closely at this, we can see that interest rates generally go in trends. So from the inception of the chart in the 1920s, you can see that interest rates were not steadily, but on a downward trend from 1920 until about 1950. And then from 1950 until about 1982, you can see that interest rates were generally trending upward to a max of around 15% in 1982. And then ever since 1982 to the present, they've been in a downward trend. So this shows you that any policy written since 1982, the farther back it is, the higher the crediting rate that would have been shown on the illustration. So you can see here that the illustration is not a contract. It's just showing you what the policy would look like if it performed at a given rate. It's not showing you what it's going to perform like. It's not any kind of obligation on the company. It's not a guarantee. It's just simply showing you a what if based on this current rate. But we know rates aren't constant and that they're either going up or typically going down. And there's some, as you can see, volatility around that trend line. My goal is not to scare you away from purchasing a life insurance policy. My goal is to make sure that you understand that dividend and interest crediting are a function of market interest rates. They will rise and fall over time. All right, so hopefully that's a good overview of why we shouldn't rely on life insurance illustrated crediting rates to make a decision on whether or not to purchase a policy. Clearly some companies will illustrate rates that are higher than others, but even in the case of a whole life where that's the rate that the life insurance company is paying, we know that that rate isn't going to be the rate that you're paying forever. And in the case of an index universal life, it's really just a guess based on historical performance of what would have happened had the rates been at that level. So again, it's not a statement about what the insurance company has the potential to make. It's just a what if based on historical performance. So what factors should we consider when we're evaluating a life insurance policy? Well, the factors that I would use are the insurance company's charges, if there's any competitive advantage that one insurance company has over another or one product over another, and finally, the financial reserves of the company. So let's take a look at the policy charges first. It's important to understand that different companies are going to have different charges, and it's quite likely that those charges or the difference in charges can get completely washed out if you're also at the same time seeing different interest crediting rates used by those policies on their illustrations. So my advice is to just keep everything apples to apples. If you're evaluating 4 different policies, then ask the agent to hold the interest crediting rate constant across all those policies. Now, typically, life insurance agents don't have the flexibility to illustrate at a higher rate. And that's just the insurance company protecting itself against a dishonest agent showing an overly optimistic illustration to an unsuspecting client. So typically, you can show a lower rate, you just can't show a higher rate. So just find the lowest common denominator and ask that all the illustrations be run at that rate. And this holds true whether you're talking about whole life or IUL, or comparing a whole life against a whole life against an IUL against another IUL. When you hold everything constant, it allows you to see which policy illustration will perform better at that rate. So what that's telling you is which company has the lowest charges. And now you can see that because you're holding the rate constant. Before, it might have been buried in the fluff. And then in the case of an indexed universal life, I think it's also important that you hold the rates constant across different interest crediting options. So you might have options that are tied to the S&P 500. You might have options that are tied to other stock market indices. But whatever they are and whatever their historical performance is, just hold those rates constant. You want the overall illustration to just use a constant rate that you can compare against other companies so that you can determine which policy has the lowest charges. All right, so that's the charges. That's to me, one of the most important things that you should be looking at is run apples to apples illustrations. The next is competitive advantage. Now, we're talking about life insurance here, so it's an industry that's been around for a long time, and there's not a whole lot of innovation that goes on in a pretty generic product. But that said, over the last 30, 40 years, we've also seen the introduction of universal life, index universal life, and variable universal life. And each of these brought about some significant changes to the industry. So when you're comparing illustrations, be sure to take into mind any competitive advantage that one policy or company may have over another. Allianz is a good example, and I don't know how true this is across the entire industry, but most IUL companies farm out their hedging activities to Wall Street companies. It's not their area of expertise. Their guys are used to buying and trading bonds and maintaining the general fund of the company. But in the case of an index universal life, you're hedging with options on a market index in order to capture as much movement in the market index as you can get with the money that you have to spend. So anyway, Allianz brought all of their hedging activities in-house, and they claim that they've reduced their costs significantly, which allows them to offer higher caps, or on the flip side of that, potentially invest in safer assets and still be able to offer a competitive cap to their clients on their products. So policy charges, competitive advantage, and lastly is the financial reserves. And again, a picture is worth 1,000 words. So let's take a look at this graph. So you should realize that for the most part, insurance companies all invest in safe, secured debt instruments. While they have an incentive for the cash value to grow as quickly as possible, they cannot risk losing their money either. And for a life insurance policy to function properly, the policy merely needs to meet its minimum actuarial rate, basically the guaranteed rate. They don't need to speculate. But it's also important to note that differences between dividend rates between companies can also be explained by subtle shifts in the underlying risk of their holdings, as this graph illustrates. So these data are from the annual reports of two different companies, MassMutual and Securian. And I'm not going to pass judgment on which one is better than the other, because primarily I don't want to have to talk to the attorneys from either one of those companies. So you need to form your own judgment, make your own judgment call on, what you think is a safe and realistic or strong portfolio. But if I can just direct your attention to the first line of each of those, which is the bond holdings of the company. And in the case of MassMutual, you can see that it's about 53% of their portfolio is invested in bonds. And that means about 47% of the portfolio is invested in other assets, such as mortgage loans, derivatives, common and preferred stocks, even the policy loans that they make to their clients are considered part of the assets of the company. In the case of Securian, you can see that their bond holdings make up about 74% of the total holdings. So about 3/4 of the holdings are bonds. And then the pie chart to the side of that actually shows you the breakdown of the quality of those bonds within those bond holdings. So if 75% of the holdings are bonds, that means that there's only 25% invested in other assets such as mortgage loans and other types of securities. So again, I'm not going to pass judgment on what is better than the other. I'll leave that up to you. But if you're looking at multiple companies, I think it behooves you to take a look at their annual reports, which are available on their websites. If you just Google the name of the company and annual report, it should take you right there. And download the annual report and find the assets and take a look for yourself and just compare one company against another. If one company is offering a higher dividend rate than another, or in the case of an IUL, if somebody has higher caps, I think it's important to understand why one company is able to do more with the same than another company. And their holdings kind of gives you an idea of that. So, it's important to understand or note that there's an inverse relationship between the risk and reward. So if a company is buying riskier bonds, the bond issuer needs to offer a higher rate of return in order to entice investors to buy those bonds because of the higher default risk. And then the opposite is true as well. If the lower the risk, people are drawn to lower risk, but they can get away with offering a lower rate of return. So the safer a portfolio, typically the lower the return on it, and the higher the risk in a portfolio, the higher the potential return, because there's always that default risk. So you need to make a judgment call on your own. Here's something I can't speculate on and I can't pass judgment on because, again, I don't want to talk to the attorneys of those companies. All right, so the point of this whole presentation was to show you why you shouldn't rely on the illustrated crediting rates used by the insurance company on their illustrations. And I think I showed that, interest rates are always changing and the illustration is going to be out of date from the time that the policy is issued. So it's important to just understand at its core what the insurance company is investing in and think for yourself where interest rates are going, and just be sure that no matter what happens, you're going to be happy with the results. And that's why I think that it's best to run the illustrations with apples to apples input assumptions and always use a lower assumption, find the lowest common denominator across all the different policies that you're looking at. Because in the worst case scenario, you want to make sure that that policy can survive. That's the most important thing. And then lastly, I showed you what you should be looking at instead when you're making your decisions. So that's the policy charges, any competitive advantages that a company may have, and the financial reserves of the company. So if you're hungry for more information and you're not ready to talk to a life insurance agent yet, I highly recommend that you go out to Facebook and join my double play group there. That's a community of like-minded people who are all either doing this or interested in learning about this. And a lot of the content that I post out here on YouTube and other places is also cross-posted on that Facebook group. But if you don't want to talk to an agent, it's a great place to ask questions of the membership there and get your answers to the extent that they're not provided in my videos, or you don't want to look through all my videos to find what you're looking for. I should also point out that all of the resources for this topic are available on my website. That's innovateveretirementstrategies.com. And I pride myself on the website being a no fluff zone, meaning that it's all solid, high quality content that answers your questions. And there's no fluff and no effort to try and just capture your email address. And frankly, no selling either. It's just trying to get out as much good quality information as possible, because I'm pretty confident you want to deal with somebody who understands this subject matter. And finally, if you enjoy getting all this information for free, please consider supporting the production of these videos by going down to the description and going to buymeacoff.ee and supporting this channel financially to give me an incentive to keep producing all this content for free for you. So with that, that's all I have for this video. I will see you in the next one.